Let me tell you about the eighth wonder of the world. No, it's not a hidden temple or some ancient monument. It's something way more powerful and honestly way more useful to you and me. Albert Einstein is famously, though maybe apocryphally, quoted as calling it that. And once you understand it actually works, you will see why. I'm talking about compounding. If you have ever wondered how some people retire with millions of dollars with ever earning a huge salary, how a small, boring, consistent habit can turn into life-changing wealth over time. The answer is almost always the same word, compounding. In this video, I'm going to break down exactly what compounding is, why it's so much more powerful than most people realize, the key factors that control how fast it works, where you can actually put it in real life, and what a simple mental shortcut, the rule of 72, that lets you estimate compounding in your head. Stick around till the end because I will also give you a practical step-by-step action plan you can start using today. So let's get into it. So what is compounding? So what actually is compounding? In the simplest terms, compounding is the process of earning returns not just on your original investment but also on all the gains that investment has already produced. Think about for a second, with most things in life, effort and results are pretty linear. You work an hour, you get paid for an hour, but compounding breaks the rule. Your money starts making money, and then what money starts making money too? It's a loop, a snowball rolling downhill, picking up more snow, getting bigger and rolling even faster because it's bigger. Here's the mechanism in 4 steps. First, your original principle, the money you put in. Earnings the starts earning a return. Second, instead of pulling that return out and spending it, you reinvest it back into the principal. Third, now you have a bigger base of money and that bigger base earns even more in the next round. And fourth, and this is the magic part, this cycle keeps repeating and the growth doesn't just add up, it accelerates. That's the fundamental difference between compounding and just saving money in a jar. A jar full of cash next year is the same jar full of cash plus whatever you added. But a compounding investment grows on its own even if you never add another dollar. Let's make this concrete with an example because the numbers make this click in a way that theory never does. Imagine you invest $1,000 at a 5% annual interest rate. Let's compare two scenarios, simple interest and compound interest. With simple interest, you can only earn 5% of your original $1,000. That's $50 every single year, no matter how long you leave it. Year 1, $1,050, year 2, $1,100, year 3, $1,150. That's a straight line, predictable but slow. Now, here's the compound interest. In year 1, you earn 5% of $1,000, so you are at $1,050, same as before. But here's what it changes. In year 2, you don't earn a 5% of the original $1,000 anymore. You earn 5% of 1050, your new larger balance, that's around $52.50 in interest, bringing you to $1,102.50. And in the third year, you can earn 5% of $1,102.50, which is about $55.13, bringing you roughly the total to $1,157.63. Notice something? After just 3 years, compound interest has already pulled ahead of simple interest. $1,156.63 versus $1,150. It doesn't look just like much yet, but the gap doesn't stay small. It gets wider and wider year after year because every single year the base you are earning interest on keeps growing. This is the accelerating curve that separates linear growth from exponential growth, and it's the entire reason compounding has a legendary reputation in finance. Now that you understand the mechanism, let's talk about what actually controls how fast compounding works. There are 4 major levers. Factor number 1, time. This is, without question, the most single important factor. The longer your money has to grow, the more compounding cycles it goes through. And remember, each cycle builds on the last one. This is exactly why financial advisors are obsessed with telling young people to start investing early. It's not about being able to invest more money, it's about giving your money more time to snowball. Someone who starts investing modestly at 25 will often out-earn someone who invests far more starting at 45, purely because of the extra 2 decades of compounding. Factor number 2, interest rate or the rate of return. Obviously, a higher rate of return means more money gets added to your principal each period, which accelerates growth. But here's the norms. Higher returns usually come with higher risk. So this isn't just chase the highest number game. It's about finding a rate of return that fits your goals, your risk tolerance, while still working in your favor. Factor number 3, frequency of compounding. Interest can compound annually, quarterly, monthly, or even daily. The more frequently it compounds, the faster your money grows because interest starts earning its own interest sooner. Daily compounding will always slightly outperform and the annual compounding at the same stated rate. It's usually a smaller effect than time or rate, but it's real and it adds up over long periods. And here's the factor number 4, consistent contributions and reinvestment. This is one that actually is in your control every single day. Regularly adding new money to your investment and reinvesting every dividend, every bit of interest, every capital gain keeps expanding the base that's compounding works. This is the difference between a one-time deposit and an active habit of building wealth. But put those 4 together, time, rate, efficiency and consistency, and you have the entire recipe for how compounding accelerates. Okay, this is all great in history, but where does compounding actually show up in the real financial world? Let's go through it. In the slides you can see I have already explained these things. Here the time, the interest rate, the frequency and compounding. Now, savings accounts and certificates of deposits, CDs. This is the simplest Example, your bank pays you interest on your deposit and that interest gets added right back to your balance where it starts earning its own interest. It's not flashy, but compounding in its purest form. Stocks. This is actually one works in two ways. First, capital appreciation. If a company's stock price goes up, your investment grows in value. Second, dividend reinvestment. Many companies pay dividends and a lot of investors use what's called a DRIP, a dividend reinvestment plan, which automatically uses those dividend payments to buy more shares. More shares means more future dividends and more potential capital appreciation. It's compounding directly but built directly into the stock market. And here's the mutual funds and ETFs. Yeah, that's a more commons in nowadays. These are the baskets of stocks, bonds, or other assets. As the underlying investments grow in value and as dividends on or capital gains get distributed and reinvested, you end up owning more units of the fund, which increases your future growth potential even further. And finally, retirement accounts, 401ks, IRAs, and similar accounts. These are frankly some of the best vehicles for compounding that exist because of their long time horizon and their tax advantages. Money in these accounts often grows tax deferred or even tax free, meaning your gains are not getting chipped away by taxes every year. That means more of your money stays in the account, compounding further instead of leaking out to the IRS along the way. So now here's one of my favorite tools in all of personal finance because it lets you do a rough compounding calculation in your head. No calculator needed. It's called the Rule 72. Here's how it works. Take the number 72 and divide it by your expected annual rate of return. The result is roughly how many years it will take for your investment to double in value. Let's run though some real numbers. At a 3% return, 72 divided by 3 is 24. So your money doubles in about 24 years. At 6%, 72 divided by 6 is 12 years. At 9%, that's 8 years. And at 12%, that's 6 years. See the pattern? As your rate of return goes up, the doubling time drops drastically. This is a great gut check tool. Whenever someone tells you about an investment opportunity, you can instantly estimate whether the growth they are promising is realistic or even a red flag. Let's put this in real world scenario. Say you invest $1,000 one time, just once, no additional contributions, and it earns a 7% average annual return. Using the rule of 72 divided by 7 is roughly 10.3 years to double. So after about 10 years, your $1,000 has grown to around $1,967, basically doubled. After 20 years, it's roughly $3,870. That's doubled again. After 30 years, you are approximately at $7,612. And after 40 years, a single generation, that's original $1,000 has grown to nearly $15,000. Let that sink in. One deposit, no additional contributions, just time and a steady rate of return doing the work. This is exactly why the phrase time in the market beats timing the market gets repeated so often because the earlier you start, the more doubling cycles you get to experience. So how do you actually put all of these into practice? Let's break it down into clear 6 action steps. So I know you have hammered these points already. Start early, but it deserves repeating. The most impactful action you can take is to start now, even with a small amount, because time is the ingredient that makes compounding powerful in the first place. Step 2. Invest consistently. Make regular contributions, something monthly, bi-weekly, whatever it fits your budget, even if they are small. Consistency beats sporadic large lump sum investments, because you are consistently fitting new principal into the compounding machine. Step 3. Reinvest your earnings. Whenever you receive dividend, interest or capital gains, put them back to work instead of spending them. This is what keeps the snowball rolling instead of melting. Step 4. Choose growth-oriented investments. While balancing your personal risk tolerance, look for investments with a reasonable, sustainable rate of return. Remember, a higher rate accelerates compounding, but it should still fit your goals and comfort with risk. Step 5. Be patient. Compounding rewards people to leave their money alone. Avoid the temptation to pull funds out early or make impulsive decisions based on short-term market swings. The real payoff shows off in the years later, often decades in, so patience isn't just a virtue, it's a strategy. And here's the step 6. Minimize fees and taxes. High fees and unnecessary taxes quietly erode your returns year after year, which means less money available to actually compound. Choosing low-tax investment options and using tax-advantaged accounts like the retirement accounts we talked about earlier helps make sure more of your money stays working for you. If you just take these 6 habits and apply them consistently, you are doing exactly what compounding needs from you to work. It's magic. Now, so let's bring it all together. Compounding takes linear growth where your money grows the same small amount every year and transforms it into exponential growth where your earnings generate even more earnings faster and faster over time. The 3 things to remember above everything else: start early, invest regularly, and stay disciplined. So here's the honest truth. Compounding isn't a secret formula or a get-rich-quick trick. It's actually the opposite. It's a mindset. It's choosing patience and a long-term view over instant gratification, and that mindset applied consistently over years and decades. So it's a mindset over choosing patience Sorry, that was a quick glitch. So coming back to the point, the compounding is not a secret formula to get a rich quick trick. It's actually the opposite. It's a mindset. It's choosing patience and a long-term view over instant gratification, and that mindset applied consistently over years and decades is genuinely one of the most reliable paths to financial independence and security that exists. If the video helped you to understand compounding a little better, hit the subscribe button. I am covering more wealth building concepts like this, just one, breaking down the why and how behind building real financial security. Thanks for watching, and I will see you in the next one. Bye.